Hello and welcome to our On Point webinar with Merger and Acquisition Services. Today, we're going to discuss the current insurance market, deal structure and valuations, typical buyers, and I'm sure a lot more. I'm Jason Gaskell, Vice President of Strategic Market Sales at Oak Street Funding, and I'm happy to be joined today by Chris Hughes, Managing Director of Insurance Distribution at M&A Services. We've got a lot to talk about, so let's jump in. Chris, thanks for joining us, and maybe you can give us a brief intro and jump right into kind of a year-to-date summary on where we're at.
All right. Thanks, Jason. I appreciate it. Thanks for hosting this webinar today. I appreciate it. Again, my name is Chris Hughes. I'm Managing Director at M&A Services for a boutique investment bank focused exclusively on the insurance industry. I head up our distribution practices, so I work with all companies that are retail insurance agencies, wholesale insurance agencies, MGAs, MGUs, management companies of RRGs, anything that touches the sale of the insurance product. Those are the type of companies that I work with and our team at M&A works with. Our firm also works on insurance carrier transactions, and we have a broker-dealer that does some capital raising functions as well. We've been in business for 25 years now. I've been with the firm since 2010, and I've concluded over 60 successful M&A transactions, primarily on the sell side. So that's a little bit of a commercial about me and a little bit about our experience here at the firm. But in our last conversation, I believe it was in the fourth quarter of last year, we talked how all of 2024 went, how that was a gangbuster year. Valuations were at all-time highs. I think through the first half of this year, not only have the valuations continued to hold on, but maybe even crept up just a little bit. And here with the most recent, 50 basis point rate cut, you'll have even a little bit more upward pressure on valuations as we walk into the fourth quarter of this year. Some of the buyers, from 2024 and 2025 have kind of changed a little bit. You saw a record number of deals in 2021. I mean, just the number and volume of deals as the federal government pumped a lot of stimulus money into the economy. Well, private equity took that and ran with the ball there, especially with insurance agencies. So we had a record number of deals in 2021, and a lot of deals have 2 or more commonly 3-year earnout components to them. So the deals that happened in 2021, a lot of earnouts are coming to due in 2024. So some of the buyers that were very active in 21, BRP in particular, right, announced that, hey, we're going to take just a little bit of a pause unless there's a really strategic function as we pay out these earnouts in 2024. Those are being paid out right now, in real time as we speak. So I expect maybe some of the participants in 2025 will be back in the marketplace. You also saw some of the more highly leveraged firms like a PCF, take a pause as interest rates spiked really quick, recapitalized themselves, and now they're back in the marketplace as a very active acquirer in 2024, whereas they've taken a little bit of more of a pause and measured approach in 23. So I think you're just seeing a little bit more of shift of who the buyers are as we walk into 2024. But as interest rates come down, and as those earnouts start getting paid out, I think we're seeing there's a lot of gasoline being poured into the M&A marketplace right now. So I'll just pause for there. And Jason, what are you seeing right now?
Yeah, thanks, Chris, and thanks for that update. I think, we're seeing a lot of similar aspects when it comes to activity. Obviously, interest rates may have slowed things a bit. There was still activity all throughout. Obviously, it's still never a bad time to make a good acquisition. I think as people started to recognize the normalcy of the interest rate environment, we saw an uptick in transactions. And now with the Feds and the reduction starting to occur over time, I anticipate that will continue to increase our load that we're seeing from an acquisition standpoint.
Well, that's awesome. So in terms of that rate reduction just happened in the Fed, how fast does that affect your deals? What does a typical look like? How fast do rates change and terms change from a financing standpoint?
Yeah, it's kind of interesting that you asked that, Chris, because actually we benchmark our rates against the U.S. Treasury notes, and so our variable rate is tied to the 30-day UST. A 2 or 5 year fixed rate would be tied to the respective 2 or 5 year T-bill, and we actually saw a great deal of movement, especially in the 2 year T-bill, several weeks before the Feds even made their official announcement. So we started to see a reduction in those benchmark rates before we even heard anything official from the Feds. Everyone was kicking around whether it would be 25 bips or 50 bips, but all through that conversation, we saw the T-bill starting to come down. So we've already seen an impact even before the Feds made their announcement the other week. So that's it's great for our borrowers. It's great for anyone who's in the borrowing industry. You go.
Yeah, excellent, excellent. So on typical deals, there's definitely a cash and equivalence component to it, and that's been very strong throughout 24 and 25, maybe even a little bit stronger in 25. There's oftentimes some buyer's equity that goes into a deal. So if you're talking with if you're doing a deal with the Hill Group or World or Risk Strategies, there's always some kind of buyer equity that's put into it. Um,
You go.
More recently, I'm seeing a little bit more interest in sellers retaining a 10, 15, or 20% equity stake in the deal. In every deal that I see, there's some kind of growth earnout component. So you're getting like really, cash at closing, as well as, kind of it at the seller's option. Some either retain seller's equity in their own company or some buyer's equity as part of the closing consideration. All of the earnouts that we see, whether they're 2 or 3 years, are generally built off of a compounded annual growth rate. And they're really kind of like icing on a cake. You're getting your 100% valuation at closing, plus you can get these stepped up earnouts over a 2 and 3 year period. Um, what are you seeing in terms of lender financing? What does a typical deal for Oak Street look like? Do you see or consider equity that goes into the deal, whether it's the seller's equity or the buyer's equity?
Yeah, I think for us, we have a great deal of latitude to look at each deal individually. I think that's one of the aspects that make us really competitive in the market. But I would say if you asked about maybe a Goldilocks deal, right, that's just kind of the right blend of everything, we will typically look at financing up to about 80%, ideally, of a purchase price. And then that remaining 20%, it could be any combination of cash equity, seller note. I know in previous conversations you and I have had in the past, we talk about the seller note versus an owner equity or an earnout over time. And it's funny, we see a lot of times still in the insurance industry, a lot of those kind of old school promissory note, seller financing pieces. And it's really advantageous, I think, to everyone involved. And sometimes we'll find a seller that cares to carry a little bit more of that note back for any number of reasons, whether it be tax implications or they enjoy still having some skin in the game. From our standpoint, and really from the borrower standpoint, that's a huge consideration for us. It really helps ensure that transition is going to be a warm handoff, that any large accounts are transitioned properly, and really help mitigate any risk associated with that as opposed to just having kind of a drop dead date where everyone kind of goes their separate ways.
Sure, sure. Well, a lot of my deals with valuations being so high, I think like in a $2 million EBITDA transaction, we're seeing valuations, and, for a well-diversified, strong bench team, we're seeing valuations in the 10 to 12 times space for, $2.5 million of EBITDA on maybe a 30 to 35% EBITDA margin deal. But with that high valuation, what we are seeing this year and a little bit last year as well is a little bit more increased focus on the financial diligence aspect and the legal diligence aspect. So there's, the legal teams and the third party quality of earnings teams that are coming in are just putting a lot more emphasis on the adjustments that go into there, some of the buyer synergies that go into a deal. Not taken for face value, but really digging into all of those pro forma adjustments and really digging into companies' financials through the diligence process. Not that things don't hold up, but I think there's just an increased focus this year on financial due diligence and a little bit so on legal diligence. from a third party diligence standpoint, we see a lot of firms like our competitors out there that are doing that financial diligence. But in terms of lenders, what does Oak Street do? Do you bring in your own attorneys? Do you bring in an outside firm, or do you really rely on the buyer's financial diligence team?
Yeah, I think that that can be broken up kind of into two different buckets. For smaller deals, we're comfortable using some sort of internal valuation that we would utilize over a certain dollar threshold, exposure threshold. We would want to see a third party valuation conducted. You know, you talk about multiples of EBITDA and how they continue to increase. You know, part of our risk mitigation is we have some limitations when it comes to how much we're willing to finance as far as that's concerned. But to your point earlier, that's where we see a lot more of these equity opportunities come into play, and deal structure. I mean, that's where it really becomes key to have a good partner that can structure that deal such that you can utilize bank financing, bank debt. You can utilize the seller, and you can have some of your own, you know, the buyer can have some of their own cash injection, equity injection if necessary. So, you know, as we get into higher thresholds, greater exposure, I think the complexity of the deals can certainly increase, and all the more reason to have somebody to kind of walk them through and help walk a buyer through that process. And quite frankly, the seller through, so that they understand the advantages to all the different aspects. Because I've certainly run into sellers in the past that struggle with some of these aspects until it's explained. And then, you know, it makes good sense to them. So that's where someone like yourself really is advantageous to have on board.
Yeah, thanks so much. So on the seller financing that we see, generally there's a predetermined multiple of the buyout. Oftentimes that's the same multiple as the closing valuation, and it usually has a predetermined, end point. And sometimes it ends at the same time the earnout does. Sometimes it's within a 3 to 5 year period, but there's a predetermined multiple. There's a predetermined kind of put call option with a time frame put in there. Do you see that on your seller financing deal, or does it run concurrently with the lender financing piece of it?
Yeah, I think that's a great aspect of Oak Street funding as well, is our loans, we'll look at fully amortizing a loan over 10 years, fully amortized over 10 years. Most sellers don't want to be in for 10 years. So oftentimes, you know, there are competitors in the market that want to limit their exposure to the same length of time that the seller has their exposure out there. We do not require that. So oftentimes we see a much quicker burn. 3 to 5 years, I think, is usually pretty normal on that earnout provision. And we're very comfortable with that. I mean, we'll look at that, but that certainly will work as far as we're concerned, while still maintaining that 10-year term on the loan itself.
Sure. And in every deal that we do, and primarily I work on the sell side of transactions, but we're putting together pro forma financials, and we're putting together revenue synergies. So oftentimes, a seller might be much smaller than a buyer, might be accessing wholesale markets, which often pay commissions, 8 to 10% range. Whereas if they had direct access to carriers, they would be getting a 13 to 15% commission, just depending on, what line of business it is. And we build some of those pro formas into the revenue synergies, which increases the EBITDA margin. You also see a fair amount of expense synergies, the biggest one being, especially in the smaller deals, the, less than $2.5 million EBITDA deals, you see a lot of owner operators that may either be taking no salary because they're taking it all at the end, or they're taking a higher salary, may have wives or other family members that are on the payroll to access health benefits. But we pro forma all of those expense synergies out. We see that oftentimes there might be an accounting function for a small deal that a buyer already has. So we might take out accounting functions and things like that. How does Oak Street look at those pro forma financials that either an investment banker would do or a buyer would do when they're looking to finance the deal? And just to follow up, Jason, do you include both the seller and the buyers combined pro forma, or do you just look at the seller by itself on a standalone basis?
Yeah, so a couple different pieces to that. I think the short answer is yes. We oftentimes ask as part of the deal, and part of our loan packet, for a pro forma projection. Obviously, it's key to see how those synergies align and what that's going to look like moving forward, because we know there's going to be some real cost savings, oftentimes in the business aspect of things, but certainly to your point, from an owner salary or family salary standpoint, certain expenses that can be documented as going away, we want to make sure we're giving credit for those. From both the buyer and the seller standpoint, I don't think we typically just ask for a pro forma, and that pro forma is going to show the conjunction of, as I often make it in very simple terms, A plus B, what C looks like, right? So you've got your buyer, you've got your seller. What's that going to look like? So those adjustments could include some of the aspects of the two businesses coming together, some expenses perhaps going away, certainly. On the buyer side, I don't know that we're typically looking for any specific pro forma individually. It's really going to be more, what does it look like with the addition of the target agency into the mix? What's that going to look like? So we usually just ask for that one pro forma as to kind of what is this going to look like holistically moving forward.
Sure, sure. And oftentimes when we're working on evaluation or we're looking at a deal and we're advising whether it's the buyer or the seller, we are looking at the deal with and without debt. I put together this nice little slide just showing the difference of even using leverage at a 10% interest rate over kind of a 3-year period. You can see, on a cash on cash basis, using debt, using pro forma financials, using an earnout and some of these synergies that go in there. You can see your return on investment go from 1.7 times cash on cash to 3 times cash on cash. And that's, with a relatively high interest rate over a relatively short period of time. Well, what do you see going forward as we walk into the fourth quarter this year? And what do you think the first quarter of next year is going to look like? I know we just saw recently this rate reduction. Do you see another reduction coming this year or the first quarter of next year? And how do you think that's going to impact the flow of deals that are going to Oak Street?
Well, I wish I had that crystal ball, I suppose. I might put my money on the horses at that point. But I mean, I think certainly all indications are that the Feds are going to continue to step rates back incrementally. There are a number of different kind of thresholds being tossed around, and internally our people with their ear to the rail have their own thought process on that. I think that what we've seen and what we're going to continue to see are deals being done, quite frankly. It felt like when you go back 6 or 7 years, PE came in and kind of was starting to scoop up a number of different agencies, and they were going away, and that threshold changed. And every time it felt like people were hesitant that deals may not still be there. But, my schedule can tell you that deals are there every day, all day, right? And I'm sure yours is the same. There's always deals being made, and there are always people looking to get into the industry or get out of the industry. I think a little step back from the pressures of the interest rates having gone up, which really, if we're being truthful, they didn't go up that egregiously. We just sat at the bottom for so long. I don't think I certainly worked with people that never knew prime off of its basement floor, right? I mean, like, these were people that were in business for a number of years that never realized. It made me feel old, but certainly I remembered when it was above the threes. So I think we're going to continue to see acquisitions happen out there, and I think we're going to continue to see good value in these agencies through their valuations. Whether they continue to go up, whether they plateau, I guess that's to be determined. But we typically just kind of roll with it, and we know that the deals are still going to be there, and we want to try and help in the financing as much as we can. How about you?
Yeah. I think there's 3 things that we're really going to see as we walk into the fourth quarter of 24 and the first quarter of 25. One, we're watching interest rates come down. So that's going to put a little bit less interest expense pressure on a lot of the acquirers. You see a lot of the earnouts are going to, finish paid off through the end of this year. So you're going to see a little bit more private capital come into the marketplace in the first quarter of next year. And 3, we have an election year. And on the Democratic side, there's talk of capital gains rates going from 22.9 to 28%, with the Obama tax add on to that. So I think, with that pressure, I'm not sure that's going to happen in the first quarter of next year, but there'll be that much more to talk about if that's the way the election goes. And if the election goes to the Republicans, we might even see a little bit of a lesser capital gains rate. So I think people are focused on the capital gains rates. That might create a little bit more fuel on the fire to have deals happen, sooner rather than later. So I think we're going to see those three things, the election and taxes and how that shapes out, lower interest rates, and more capital to put into newer acquisitions as older earnouts are paid out and those deals are fully closed out. So I think we're going to have a very active, next 6 to 9 months in the marketplace. Definitely the next 3. We're seeing it right now. I mean, literally for the last, 6 to 8 weeks, I'm seeing a lot more activity of owners asking about some of these questions, and especially asking a lot about, are the multiples going to stay there? Are we at the very height of the market? Should we definitely be selling right now? Should we wait 1 year? I'm fielding a lot of those questions with owners right now.
Well, to your point about the capital gains, I mean, that's really what spurred that huge increase back in 21, right? I mean, that was the big concern, that the capital gains were going to go up. So people that had been lingering kind of in the shadows, waiting and holding on, decided, well, I've got to sell now. So yeah, I mean, you're absolutely right. The election, as it often does, can certainly drive us one way or the other, maybe just on the status quo. But there's a lot of unknowns, but I think it's safe to say there's still going to be a lot of M&A activity moving through Q4 into Q1 and really through 2025, I don't doubt.
Yeah, I think so as well. Well, Jason, thanks for having me on today. I appreciate it. I appreciate giving at least our perspective on what we're seeing in the marketplace and what we've seen this year and what we think is going to happen here going forward. But I do think that we're going to be in a very active marketplace for the remainder of 24 and definitely into 25.
Yeah, thank you, Chris, for joining. And for both of our sakes, we hope that the business continues to be strong. It keeps us busy. And hopefully we can meet again next year to see if our prognostications were correct or not. So I'd like to thank everyone for joining us today on Point. And Chris Hughes especially. We'll be talking again soon. And good luck to everyone as we finish out 2024.
Thanks, Jason.
Thanks, Chris.